The U.S. isn't the only country tackling historic inflation.
That's right. The European Central Bank, or ECB, is raising interest rates 1/4 of a percentage point. It's now at 3.25%. That's the highest in 15 years. But unlike the Federal Reserve, the ECB is confident there are more hikes to come.
Joining us now is McKenna. He is an international economist at Wells Fargo. Welcome. So here in the U.S., the Fed says it may pause their rate hikes. Why does the European Central Bank plan on continuing theirs?
Well, I think there's a few reasons for that. I think the first is that the Eurozone and Europe, a little bit more broadly, has a little bit of a more problematic core inflation data coming through. So we're looking at core inflation in Europe that's trending closer to 6% on a year-over-year basis and hasn't really rolled over the way core inflation has here in the United States. So I think that's one reason. And the other reason is I think the Eurozone banking sector is a little bit sounder and stronger and more resilient than the banking sector here in the United States. So I think that allows the ECB a little bit more room to continue raising interest rates without putting some additional stress on the local banking sector. So I think that's probably why you're seeing a more firm commitment to additional rate increases from the European Central Bank than the Federal Reserve.
It's really interesting, Brendan, because here in the U.S., we're dealing with the crisis around regional banks and the lack of confidence in so many of them since there have been things that have folded. The European Central Bank, though, covers about 20 nations that make up the Eurozone. Does that make it more challenging, then, for the U.S. to address inflation while Europe's doing something slightly different?
Well, I actually think it would make the European Central Bank's job a little bit tougher to address inflation in 20 nations as opposed to just one here in the United States. But I think we've actually seen that interesting dichotomy play out across the region where countries such as Italy, Spain, France, they've actually had a bit more of struggles containing inflation. And one shoe does not necessarily fit all in Europe as opposed to the way it does here in the United States with the Fed. So I think the Fed's job is a little bit easier to contain inflation in just one region as opposed to across 20 countries in the Eurozone.
One thing we've seen, though, is how interconnected, at least sometimes even just the psychology of the markets can be. Oh, yeah. How much do these rate hikes risk a global recession?
I think it's certainly a possibility. We've seen monetary tightening not only from the Fed and the ECB, but interest rate hikes across many of the major central banks in the developed world and then also in the emerging world. And that certainly puts some pressure on economic activity at a global level. And that's probably why you're going to see the global growth rate for this year come in a little bit under the global economy's long-run growth rate average. But with that said, I think we've actually seen some dynamics over the last 6 months or so where global growth prospects have actually improved. We've seen China reopen. The worst-case energy crisis scenario in the Eurozone has been avoided. And we've actually just seen more resilient consumer spending in the United States. So there's certainly a possibility where the global economy could enter recession. I don't think that's a scenario that's going to unfold. But nevertheless, it is a possibility as we continue along the rate hike cycle in Europe and then also in the United States, possibly.
Yeah, that's the sobering reality check. Yes. Brendan McKenna, thanks for your time today.
Of course, thank you for having me.